Hello and welcome to the Miko Bits show, and I'm your host, Miko Bits. Today we're going to have a conversational show, and it's with one of my colleagues, Evan from Gumi Crypto's Capital. So, would like to introduce Evan. Evan, welcome to the show.
Thanks for having me, Miko. Glad to be here.
Yeah, so this will be a conversational show. So it's not a show as I usually do around a specific product or project. So, I guess for me, I would love to get a lot deeper into DeFi and blockchain, and really try to understand, what are your hot topics? Like, what are the things that are of interest to you recently?
Absolutely. I think it's important to note how we got here in the DeFi space now at almost, I think, 170 billion in TVL across all the different chains. So we've come a long way in just 1 year, and even more since 2017, when a lot of these projects initially started kicking off. I think what's important to note is that this has been an iterative process, and in crypto, things happen very quickly. So it's been great to invest over the last 3 years at Gumi Crypto's Capital and work with founders who are in this iterative process of improving how either tokens are distributed, how networks are bootstrapped, how talent is sourced, and everything in between, how DAOs are formed. And so this whole DeFi boom, you could call it, kind of kicked off back in June 2020 when Compound started the first liquidity mining program. Although some people credit synthetics to that before, but Compound was the first one to really popularize this back in the day. And since then, we've seen this exponential growth that's been super exciting. And I wrote an article, I think, in October 2020 on this distribution mechanism called the ownership experience, and how that will impact users over the next decade and beyond. How instead of focusing on building a nice UI, you essentially are focusing on what is the best way to distribute ownership of these protocols that will be user owned and operated in the future. And I think that's a trend we will continue to see, and that's what's leading to this explosive growth in DeFi. In terms of what's really exciting me now, it's the activity in the side chain layer 2 space. Essentially, you've got, in the last couple of months, you've had a couple networks launch that are starting to gain traction. You've got Optimism and Arbitrum on the optimistic rollup side, and you've got Starknet and Starkware on the ZK rollup side. And just a high level, if people are watching and don't know what these rollups are, a rollup essentially aggregates transactions, it executes them and stores most of the data off chain, and then stores a little bit of the data of the proof of that transaction on the main chain. So Optimism and Arbitrum use optimistic rollups, which essentially assume that the transactions are correct, and it's essentially secured by incentives. Whereas something like Starknet or Starkware uses ZK rollups, which is essentially enforced by math. So there's different ways to have these enforcement mechanisms. But the nice thing is you essentially get scalability on this second layer while still inheriting the underlying security of layer 1. So naturally, a lot of users are migrating to these platforms, including myself, and using the applications built there, like Aave and MakerDAO, and a couple others are on Arbitrum. You've got Synthetics on Optimism. I think Uniswap's on both at this point, and tons of applications being built there. And you can see the gas fees are a lot less, but you're still inheriting that underlying security. So people are a lot more comfortable moving there. There are other chains like Matic that are super interesting now, called Polygon, that have a little bit different security trade-off, but because of that have a lot lower cost. And you also have different blockchains like Solana that are kind of popping up and offering new DeFi experiences and attracting TVL, but also have similar trade-offs on performance and security. I think the important part is that users have a choice. I've always maintained this thought that, like, the most important part is that users can always choose where they want to go. When it comes to like a hold your own keys mantra, I tend to believe most people won't, but the most important thing is they always have the option to opt out of having someone hold their keys and have them hold their own. The same applies to the different security trade-offs of systems, that users can kind of go where they want to. So I think one thing we're going to see over the next few years is a lot of activity on these layer 2s, side chains, and other scalable blockchains. competing with Ethereum. But it's going to be very interesting to see how it all hashes out, especially when Ethereum moves to a sharded ecosystem, and the scalability increases. So that's what I'm looking at now. And I have some interesting thoughts on, I guess, the repricing of DeFi, as I call it, and kind of the institutionalization or CeDeFi. So happy to dive into those if you want to chat about them.
Yeah, I mean, I guess to drill in a little bit further around the layer two, definitely it's been amazing to see this expansion. Obviously, the segmentation between the more optimistic strategy and, ZK, which is a little more math based, But I guess my question to you is, kind of from a perspective of prognostication, I think you indicated that there would be choices, right? So obviously there's a ton of different choices, whether it's novel L1 consensus or L2, more in the traditional mindset. So, how do you see this shaping out? Like, what do you see are the critical drivers for expansion and adoption between layer one and L2?
So to answer your question directly, I have no idea. There is one thing I'm sure about though with these layer twos, and that's developers are shifting their time and attention from optimizing, or with these platforms, developers are shifting their attention from optimizing for gas efficiency to actually optimizing for platform efficiency. So what I think is this iterative process I described before, since 2017, that has gotten us to this point, that gets exponentially faster over the next few years as developers are able to iterate faster because they're not spending a good majority of their time trying to optimize on how to route certain contracts so that they can save 20% of gas. So they're really focused on the efficiency of these systems, and they can do a lot more because of the fee structure. So I think given the breakdown of where projects are going currently, you have all of these, quote unquote, blue chip DeFi projects, each choosing different sides. And I don't know how it's going to play out. And I don't think they do either. And that's why they're going on either one, or some are going on both, because they're just like, we're not going to play this game. We're just going to be everywhere. Wherever the users want to go, we'll be there. But what I can tell you is it's going to drastically change the developer experience and how quickly applications are shipped and the types of applications that are shipped and the efficiency of the systems that we have in these applications.
Yeah, and I think the idea of application specific compute chains becomes really interesting as long as we can maintain sort of application oriented security frameworks, right? So, obviously, different amounts of consensus, different amounts of verification and validation, and obviously different kinds of cost structures are appropriate for different kinds of applications. So, for example, one of the ideas behind gas is really related to the halting problem, which Alan Turing proposed based on his Turing machine, right? So in essence, like, just like, the original Hashcash proposal by Adam Back around the time of Satoshi, that where he cited in his white paper, the idea of the original sort of concept was that this kind of fee or transaction fee is really a form of postage that kind of forces people trying to attempt denial of service to really spend a lot of money, right? And so, for example, a programmer who creates an infinite loop in Solidity, may end up kind of driving an infinite gas price. And obviously users who are triggering these infinite loops can pay an infinite gas, right? So, obviously that's not something that can be presupposed, but like, obviously if you have you could have Turing incomplete zones that kind of have even more potential gas savings. In fact, you could even have free transaction cost zones depending on how you kind of mitigate these types of concerns. And obviously, when you see L2s like Polygon, you can just go hit up some kind of a spigot and get enough to do tens of thousands of transactions. So I think we're already in a really nice state with L2. So I guess what I'd love to kind of have you unpack, and I really appreciate the intellectual honesty of your answer, because there are entire regions where it's super hard to predict how these things shake out. I guess would love to kind of have you expand on some of these new topics you've introduced.
Yeah, I guess maybe a good place to go is future of DeFi, and maybe the repricing of DeFi, because that can be a little bit exciting to talk about.
Absolutely. Excited to get your ideas around repricing. So how do you see
Yeah,
that?
the general thesis is it comes from looking at traditional equities markets and valuations there. You've got, SaaS and technology companies trading at something like an average of 15 times revenue multiples with a lot of the money printing that's going on, and the growth in those sectors. And we finally have metrics in crypto that are comparable, at least somewhat, to traditional finance, right? We've got these revenue generating on-chain protocols, and some of these tokens that have claims to cash flows. So you can kind of directly value projects based on some of these traditional metrics. So I'll give an example. Let's take SushiSwap, right? Even right now, when the volumes are low, it's doing about 100 billion in annualized revenue, taking 30 bips on that. So doing 300 million in annual revenue. And about 50 of that is going to token holders. And so when you look at a business that's growing rapidly, has multiple revenue lines, and is an industry that's growing rapidly, yet is only trading at 2.5 billion fully diluted market cap, that's less than 10 times revenue, like you realize these things are probably very underpriced
Yeah.
for where they are compared to the rest of the traditional market. And then you ask, why is that? And really the answer is access, right? It's that traditional markets can't really access this except through venture capital. And I think that's part of what's fueling a lot of the larger venture funds and inflow into crypto venture capital. And I actually think this is the vehicle that reprices a lot of DeFi. I think that a lot of these kind of semi hedge fund style funds are going to be taking pretty large positions in DeFi protocols and actively participating in their management. We already started to see this with Sushi. It's another great example with the treasury diversification, and you have even traditional funds like Lightspeed now entering the space and participating on crypto forums, which is just crazy to see, especially for those of us who have been in the space for a while. How formalized and institutionalized some of this stuff is getting, or at least how some of the institutions are now participating in more of the crypto native activities. So I think we'll see a lot more of that, and a lot of DeFi protocols as they grow will also be repriced. So there's not only the exponential effect of a lot more TVL coming into the space and a lot more revenue being generated, but a general mispricing of DeFi being corrected. I think the other catalyst to DeFi is actually what you and I have discussed, Miko, which I think you coined or has been coined, CeDeFi, centralized,
I
decentralized
think
finance.
that's from actually CZ. I think
Okay.
CZ
Yeah.
invented CeDeFi. Anyhow, go
Yes.
ahead.
The idea being you build centralized products on top of DeFi. And in the current form, that's the Celsiuses of the world, right?
Sure.
They not only have and the BlockFis and Nexos and these other companies, they not only have lending desks and work with institutional companies, they also are participants in DeFi and are earning yield that way. I think what this looks like in the future and where we're going, we're starting to see hints of it in what Compound's doing with Compound Treasury, essentially building a business on top of Compound that's a regulated entity that deals with institutions, Aave Pro, and then building their institutional pools. And there's a lot of other projects working on kind of institutional or private pools. And this is an area of contention in DeFi. A lot of decentralization maximalists say, hey, this is ruining DeFi. You can't have these centralized pools. That's the antithesis of this space. And again, I go back to what I said earlier. It's all about having choice, right? So you can imagine in the future, there's Aave, and then there's Aave Pro, and there's the completely permissionless non-KYC pool that has its own trade-offs, and then there's the fully permissioned KYC pool that has participation from institutions. And you might be able to borrow at a much lower rate if you're willing to KYC yourself. And we can have interesting methods of KYC, like when you withdraw from an exchange, that information via the travel rule can be sent to maybe the company that's behind these permission pools and can be stored in their database and kind of be private or be verified by them, right? It doesn't have to be on chain. We don't all have to dox ourselves on chain to participate in these pools. We can still remain pseudonymous to the outside world and essentially do the KYC AML verification through these businesses built on top of the protocols. And so when I look out 5-10 years in the future, I actually see these permission pools being a lot larger because of the amount of capital that can participate in them. But I think what's important is that we still don't stop building the permissionless pools, because you should always have the choice. And more importantly, there's plenty of users in the world, probably more users in this bucket than there is not, which is the bucket of users that don't have this information or can't provide up to standard KYC information, right? So we don't want to exclude those users from the financial system. Like that is the antithesis of space if we excluded those users. So as long as we always have these permissionless pools that anyone can access, I think it's fine that we also have permission pools and allow users to make the choice on that trade-off. And I think so. I guess my prediction would be that the CeDeFi pools end up being, an order of magnitude larger than the pure DeFi pools. But like I said, that's completely fine. And there's a trade-off there as there are with many choices, and users will be able to make that trade-off.
Yeah, I mean, obviously, full disclosure, the fund that Evan and I work on, gCC, is an investor in Celsius. I've been an advisor to Celsius since 2017. So, we definitely have a lens, and through that lens, Celsius, with their 25 plus billion in community assets that they manage, they are, prolific engagers into the DeFi ecosystem, TVL, just in the quest for yield that they can, bring back to their users, right? But I think that what you're underlining makes a ton of sense, right? Because obviously their users are participating in a highly regulated zone, right? That Celsius users perform KYC as expected. But on the flip side, they enjoy sort of a fully custodial mode, because they don't belong to the subsegment of kind of MetaMask users who kind of are really hardcore, and who spend kind of their lives and lose a lot of sleep over kind of, yield farming and, it's things that you and I do, as a hobby. But I think that, broadly speaking, there are quite a few users that will kind of come in through institutional channels and through this kind of broader CeDeFi movement, right? And I think the connector will really be liquidity, right? So ultimately, these liquidity sources, can be centralized or decentralized, and we're probably going to see a lot of hybridization. And I think the repricing effect will ensue as a function of the availability of kind of hyper liquidity, right? So I think your thesis is very sound, and very, very excited to be participating, in this. And I also kind of concur that I think that people who are religious about decentralization, I think maybe I think we have reached a period in history I call peak centralization, but I think that there should be choice, right? And I think that is, I think ultimately that's what produces freedom, so I think that having the alternative is preferable to not having. So I think that's the, and obviously, if you create a binary existential war between centralizers and decentralizers, I think the regulatory authorities are going to step in on the side of the on the side of the centralizers, right? So if you create an existential war where you force the issue of KYC, agents with guns may show up at your house. So, I think, that's existential on the side of, currently lawful authorities. Anyhow, so, so would love to, have you lead us into your next segment. So tell me other things that you're cogitating about.
I guess before that, I'd like to touch on your MetaMask point.
Yeah.
Which is that the user experience in this space is still pretty horrible.
Yes.
And I think another thing that we didn't touch on that CeDeFi does is it actually allows participation from traditional fintechs. If you think of traditional fintechs these days, like take a PayPal, they're still built on kind of the traditional banking rails, which doesn't make much sense. So when you have the ability for those companies to participate in DeFi, I can imagine a scenario where by 2030, your PayPal's, your Cash Apps, all these other fintech applications look the same on the front end, but are essentially connected to DeFi on the back end. It's the same thing with users in the internet, right? Users don't know that they're using TCP/IP or HTTP. They're just going to a
Sure.
website, but all this stuff is happening in the back end. I think that's where a lot of the activity comes into, and that's part of the thesis of why this space will be a lot bigger. There's going to be millions or tens of millions or hundreds of millions of users that don't even know they're directly using DeFi, because they're going to be doing it through fintech applications.
Yeah, it's so interesting. And I think one of the reasons why I'm very confident that this DeFi movement is going to win is, at some level, it's kind of a regulator's dream, like the transparency, it's really like in terms of things like understanding liquidity of protocols, like you could just go look at them. Like, it's not a problem. So, you can use Dune Analytics, or you can just go directly into, your favorite analytic tool, and you can just look directly inside the protocols and understand their
Yep.
solvency. Like there's all kinds of, so it's
There's no
really
bailouts in crypto.
no, absolutely. And obviously we're going to see better amalgamation. We're already seeing kind of meta stability that's conferred by insurance protocols, which I know quite a bit about. And I think we're seeing obviously bug bounty. We're seeing increased emphasis on security audit for very good reasons. So we're seeing kind of this entire kind of emergent financialization of the risk stack, right? So it just feels like with the transparency, it's going to just be inherently more resilient and robust than, whatever the Lehman Brothers were doing back in 2008. So anyhow, not to get sidetracked, but I just really wanted to say that, like, it's clear to me that DeFi is going to be the winning configuration, and it to me, it represents the first kind of fundamental shift in financial technology in decades, right? If you look at the transaction processing backbones like Fedwire and these kinds of things, like the amount of innovation has just been atrociously bad. There just hasn't been much. So.
Absolutely. Maybe we should talk about insurance since that came up. I didn't have
Absolutely,
that on
would
my
love to.
agenda, but always love to talk about insurance.
Yeah, I'm
You know,
I'm super excited about insurance, and would love to get more interesting insurance related investment opportunities into our fund. So tell me what
absolutely.
your
I think that's
tell me what your thoughts are. Well, I
uh,
absolutely am bullish on the whole segment.
yes, I am as well. We've had plenty of conversation about this, and if you're watching this building an insurance protocol, please hit us up. So my thoughts on insurance generally, and maybe I should caveat this by saying I am a holder of NXM and a participant in a member of the Nexus Mutual. And I'm going to talk about Nexus here. So let me
Great.
caveat that,
Thanks
albeit
for
a
the
small
disclosure.
small position, but let's
Appreciate
disclose
it.
everything.
Absolutely.
Um, yeah, I think the best version we have in the market right now is Nexus, and there's a couple reasons behind that. And mostly it's around capital efficiency and claims efficiency, and that's areas where a lot of other protocols have struggled. So in insurance, you essentially pool capital together to underwrite risk, right? And while that capital is sitting there, you should probably be earning a return on it. And that's something that's very hard to do in a peer-to-peer model, and that's why a lot of peer-to-peer insurance markets have not worked out. I was pretty interested in cover back in the day. I actually used
Yep.
to hold some cover. Um, and that market was essentially bootstrapped by liquidity incentives, right? There was no real
Yep.
incentive to back these contracts unless you're getting paid a ridiculous amount, and no one was going to pay that amount, so they subsidized it with cover tokens. And their TVL exploded for a little bit, and the coverage purchase exploded, and then it all came back down to earth once the token did. Kind of spiraled like some of these token designs can. And so what the market learned from that is peer-to-peer is probably not the best way to go because of the cost and the capital inefficiency.
Yeah.
And so we've seen a lot of other protocols try and solve for this. I think Nexus was one of the first, and given their team has experience in the traditional insurance markets, they've
Yeah.
got a pretty good handle on how all of this works in the traditional world, and kind of try and mimic that in a more efficient manner on chain. So, in Nexus's pool, there's a bunch of ETH. A lot of that's staked ETH on the Lido pool. Um, there's the ability to do what they call, I think, pooled staking, which is essentially where you can back many different segmented and non-correlated risks with the same capital, using
Yep.
traditional models that they use in the traditional insurance world, assuming certain characteristics of like 1 in 200 year events, or however many sigma events that is,
Sure.
um, to underwrite multiple risks at once. I think they've done a pretty good job fragmenting how much risk they cover from the underlying pool, making sure that if there is a event, that all the liquidity in the pool doesn't go to cover that event. So I think they've improved on what a lot of other products have done over time, but I still think there is a lot of things to be solved on the efficiency side. Their claims process does involve voting and incentives, um, and you can imagine in the future there might be uh, essentially a board or a DAO, league, that sits and does a lot of these decision making processes after the fact, that is elected by token holders, and that might be more efficient. Um, but given the size of the traditional insurance market and how much of DeFi is covered now, I think there's plenty of opportunity in this space. So we're always looking for new founders building in this space to back.
Yeah. I mean, I think one of the things that's so important to kind of understand from the perspective of building a financial system is that, insurance really is about this kind of last mile risk management, right? So you really financialize that last mile, right? So that you actually kind of mitigate all underlying risk, right? So, then like in a sense, like if you look at it from the perspective of something like Bitcoin, right? Like Bitcoin is providing things like cryptographic and cybersecurity, as well as game theoretical, and some would argue thermodynamic and mathematical, assurances of the security of a transaction, right? But in essence, like life is kind of uncertain, which is why you should eat dessert first, right? So the whole feeling about this is if you can actually provide insurance, right, that then you can actually guarantee, right? Because in essence, you're like, well, no matter what happens, like the transaction will be backed, right? That it's going to happen, right? And if it fails to happen, we'll make you whole. So like it will be equivalent to it having happened, right? So in a sense, like this last mile security, I think will be very almost like the way that DeFi wins, right? Because in a sense, like the cost of insuring something that has this degree of transparency, and if you decentralize the actuarial function, then, you get this adjacency between derivatives and insurance, right? And then people will just be buying and selling these, products because they could just make a lot of money because the system itself is just inherently better underneath. So yeah, that's kind of my pitch, and that's my interest in this. But I think you had a couple more topics to unpack. So, this was a super meaningful excursion into insurance, but I'd love to make sure we hit your main talking points.
Yeah, always fun to go down the insurance rabbit hole. I think there's kind of like two other things that are on my mind these days. One is NFTs, and we can maybe dive into that at the end because that might go on a bunch of different directions. But
Yeah,
before
that
that,
is
maybe
a
let's talk about active and passive management in this space. Um, we've seen, you and I have taken some pitches from some projects, and we've seen in the market some active management protocols, right? Some good examples might be Enzyme, which used to be Melon, and
yep.
Visor Finance for managing Uniswap V3 positions. And
Yeah,
both these
we had
protocols,
Mona on the MikoBits show, so definitely a fan of Enzyme and Avant-Garde Finance or new projects. So anyhow,
yep,
sorry, go ahead.
yeah, absolutely. And at their core, I guess both of those projects are kind of beautifully architected smart contract designs for managing of other people's money, right? It's how do we permission different contracts so that someone else can trade them or change the positions in Uniswap v3 or create different funds or do X, Y, or Z with someone else's money without running away with it, right? Because we're in a world where we have bearer assets. So they're both beautifully architected in that manner. And they're
Yep.
essentially trying to incentivize outside managers to come in and build strategies for other people who want to essentially passively put their money into pools.
Sure.
And I think there's different characterizations of active and passive management. One I would call like active management, and one I would call like passive active management. The same kind of nomenclature as CeDeFi here, but
Nice.
active management is the melons and the enzymes, whereas passive active management is kind of like the token sets or the ribbon finances of the world, where there's more predefined sets of rules that mostly smart contracts are handling. It's not really people coming in and managing it, right? So it's still a little bit more passive from a user perspective because you're handing your assets to a contract to do the active management instead of handing it to a contract that someone else manipulates to do the actions, right? So when I think of where the space is going, I think active management is going to be a boom over the next maybe 12 to 24 months. But I'm not sure how long it can be sustained. And the reason is because of the talent needed, right? You need good managers who can manage, in the case of like Visor, you need them to manage impermanent loss risk. You need them to manage the different ranges in Uniswap. You need them to be and essentially be beating things like Rari Capital. If you want to put your assets passively into a money market, you might be able to earn more interest there without impermanent loss risk. So they
Sure.
need to have some very high quality managers there, and therefore need to have pretty high incentives. And then those incentives end up eating away at the yield that is generated from these assets. So I think one, you have a problem with the yield you can generate from an active strategy, and two, you have a problem with attracting the talents, because to attract the right talent, you have to essentially eat into that yield. And so I can envision a scenario where, like I said, next 12 to 24 months, a lot of capital flows into these actively managed protocols. But longer term, it's more highly specialized, more like fund on-chain funds that are using these protocols that are charging a higher fee, but are some of the best managers in the world, so they can demand that higher fee. Whereas a lot of users end up just going back into more passively active managed strategies or passive or straight up passive strategies long term. So
I mean,
I think it'll be very, yeah, go ahead.
I was just gonna say, like, a lot of this kind of relates in some ways to kind of product definition and kind of capital flows, right? Because if you think about like, just like someone like yourself, right? You're a talented, proven manager, right? And in a way, the competition then becomes kind of like, well, do you just want to run and create like an enzyme vault and just have random people, throw money your way that you can manage, or do you want to continue to be part of like an institution like Gumi Crypto's capital that's a little more centralized, right? So obviously, Gumi has to compete for, talent like you and say, hey, it's going to be much better for you over here, right? And so in a way, like if you think about the capital flows, one of the really interesting like kind of institutional capital flows become sort of traditional LPs or limited partners in venture funds, right? And those people are not about to ape into active vaults on Enzyme. Like that asset class, like pension funds, like none of that's going to happen anytime soon, right? I can
Yeah.
assure you. So my feeling is that there's still a while, during which, and should that occur, should something like that transition occur where a pension fund is going directly into an enzyme vault, like, at that point, like gCC is an enzyme vault or similar. So like,
Yeah.
like, and then we're all like, part of a DAO basically.
And that's what I was saying. Like some of the top managers might end up running on-chain funds, right?
For sure.
And I should also
That'll
caveat
take
all
time.
this with I've been completely wrong many times in my life, so I could be completely wrong on any of these predictions. But it's always fun to bookmark them and then look at them in the future.
No, and I think it definitely goes without saying, but I really appreciate the declaration as almost a statement of appropriate humility, because I do think that people do often misrepresent themselves as all knowledgeable, especially in crypto, and I think that people who do that are quite suspect, so I think appreciate the comment. Well, good. And I think your last topic you wanted to unpack was NFT, right? Which is kind
Let's
of,
talk
it's
NFTs.
not,
Let's do it.
NFT is definitely not a rat hole. It's like more like a rabbit hole, right? So, it's sort of
Yeah.
you're red pilled and you're going down there. So like, would love to have your take on it.
Yeah. Uh, First of all, let's start with the disclosure again. So, Gumi Crypto's Capital was a seed investor in OpenSea back in 2019. We were a seed investor in Yield Guild Games, which works closely with Axie Infinity in 2020. And we've also backed an NFT marketplace this year called Curio. So we do have some exposure to this area and kind of horizontal marketplaces that
And
many of
and
you are
other
probably.
other unannounced opportunities as well. So
Yes,
anyhow.
yes. So we do have exposure to this space, and if we do talk our books, know that we're talking our books. um, but yeah, I think OpenSea is a phenomenal company. Obviously, we saw this fairly early, and we're lucky enough to get the chance to work with Devin and Alex. And I think what they've done is kind of built out the Google and eBay, Amazon, and kind of unity of NFTs. So let me unpack that a little bit. They have by far the best indexing and search functions for NFTs currently. They've indexed across pretty much every NFT, sometimes across multiple layers and multiple chains. And if they haven't done it on a chain or layer yet, they will in the future. So they've got that's the Google function. Then they've obviously, you can go on, you can buy and sell, you can make offers on NFTs. That's kind of the eBay function. And then through their SDKs, you can essentially build games and leverage this digital world in your game through their SDKs. And also, not to mention, their API is used by basically every wallet to display these NFTs
Yep.
in your wallet. So they're kind of this NFT conglomerate that has really exploded over the last few years. I think when we invested, they were doing 500K a month in volume, and one of their most recent launches was like 4 billion. So
And we're
it's really exploded.
we're not allowed to comment on the obvious question around OpenSea, which is sort of when tokens are. So but I just wanted to toss it out there. But but please go ahead. I think the OpenSea is a great anchor point to talk about the NFT movement, and obviously there's quite a lot more to it than that. So please
Yeah.
proceed.
Yeah, let me clarify. It's 3.4 billion. I was getting a little ahead of myself. So that was their volume in August.
Yep, good
Um,
month.
but yeah, I guess what excites me about NFTs, one, it's a major onboarding vehicle for retail users, right? We haven't seen this much retail excitement since, I guess, ICOs maybe. And I don't want to drop a barrel or an
It's
analogy
bigger.
between.
It's way bigger than ICO.
It is. It is.
I mean, NFL
Um,
Top Shots coming. Like we got. There's a
yeah.
lot.
Yeah. But I think that's one exciting part about NFTs. I think the parts that excite me as someone, in the space is a few things. One's kind of the financial side of NFTs, the financialization of NFTs and NFTs as structured financial products, right? You can think of there's a lot of composable things you can do with NFTs now. And one of them, there's this project called Charge Particles, which we don't have any
Yep.
relation to, but I just think is really cool. So you can imagine taking multiple ERC20s, like maybe a compound CUSDC, and then maybe a Nexus Mutual put option contract through there, or some other put option contract, or some sort of insurance product that's tokenized as ERC20, taking those two assets, putting them together and creating a risk-free rate, right, in an NFT on Charge Particles. And then eventually in the future, you could fractionalize that and essentially create like risk-free bonds, right? That's just one basic example,
Yep.
but there's all of these different things you can do with these composable, money Legos that can be enabled by NFTs. And I think that's where a lot of financial activity will happen, right? In the real world, uh, each stock is kind of held at a certain registration in the name of someone else. So there is unique metadata to each stock, but it can still trade in a pool of like assets. And I think that's where we're moving to. You'll have unique metadata attached to these assets, but still the ability to trade them in pools that are of similar assets. I think once we get there, that's when
Yeah.
where we'll see the explosion of financial NFTs.
Absolutely. Like for example, one of the mindsets that's important to think about in the context of financialization is that you can kind of almost look at an NFT maybe like the way you might look at a browser cookie's relationship to sort of an account access or account management paradigm, right? So, in a sense, account in the financial context tends to kind of confer rights, right? So as you have an account,
Yep.
you have rights, right? So the thing that becomes really interesting about financial NFTs is that you're kind of almost like, well, my wallet has this thing that's akin to like a browser cookie that confers sort of rights to access or rights to control or rights to do just about anything you can imagine, right? So in that
Yep.
sense, like making these financial control points non-fungible, it's a little bit less like a traditional financial asset. It's more like a contract or a set of rights, right? Like so I think that becomes super interesting and very granular.
And that was the second thing I was going to talk about. You read my mind, Miko, which is NFTs as access control mechanisms, and rights mechanisms online in the digital world or metaverse, right? You can imagine that even things like your reputation could end up becoming NFTs. But earlier on, you can essentially gate access to things like different websites, different areas in digital worlds, even the ability to access certain contents or participate in certain pools in DeFi, or there's a million different things, but NFTs as an access control mechanism are going to be very important and well used in the future. Um, and I think the third thing is as a medium of the growth of play to earn and in gaming, right? I think
Yeah.
that's a big part that we have yet to see fully come to fruition, but we've definitely seen incredible growth insofar as evidenced by Axie and YGG. I think um, just for higher level background, play to earn is this idea in gaming that we're moving from a pay to win model, which a lot of games are now, where users pay in a lot of money just to win a game, or even a pay to flex model, which is like Fortnite, where Fortnite generates something like 3 billion a year. It's like a top 10 clothing brand in the US, and it sells digital clothing, right? That doesn't
It's
help you
it's
in the game. It's
cosmetics.
just a way to exactly.
Cosmetics
So
company.
we're moving from this model in a closed model to open economies where users can put money in but also take money out and use their assets to generate some sort of income in game. And Axie is kind of the first large version of this, where you have tens of thousands of people currently in the Philippines earning well over the minimum wage playing Axie through mostly through Yield Guild and the guild structure, borrowing assets that they might not have been able to purchase themselves and using those in game, and then growing their wealth, and then owning their own assets, and then lending those out to other people, and it creates this virtuous cycle that helps people. And I think when I look out again, like 10 years from now, I think there's going to be 100 million people playing play to earn games and using that as a mechanism to live, and like that's how they earn their income. I don't call it a, some people have compared it to universal basic income. I don't believe it's that, because there's still work involved, right? I think universal basic income has this connotation that it's like given to you. It's a right. It's a basic right. What I like to call it is universal accessible income, right? Anyone with access to the internet can access this income stream if they're willing to spend the time, right? So I think that is what's super exciting. I think when we talk about crypto changing the world, I think gaming is one of the areas that's one of the easiest entries to the rest of the world, since there's 2 billion gamers. And so kind of like this financialization of games, play to earn, and DeFi all culminating together is what's going to be like most popular for the mainstream first, before these kind of traditional financial applications end up being used by everyone. I think that's what's going to go mainstream.
Yeah, and I did want to give a quick shout out there in this context to one of our portfolio companies, Bling Financial, which at 6.5 million registered users is actually one of the largest play to earn ecosystems. And it's quite it's quite poorly understood, and it's quite underappreciated in this context. So it's been an incredible journey to see. But I agree with you that my argument is that the entirety of crypto is pay to win until the advent of the sovereignty, the declaration of sovereignty over individuals' non-fungible time, right? So in a sense, these players like YGG scholars actually are not grinding Axie laborers, right? Being unionized by YGG. They're actually time investors, right? They're actually people who are investing their time, and if that starts to take off, I think we're in for a really, really interesting, next decade, right? Because, I think the numbers will be much, much larger, and I think we have 2.5 billion gamers worldwide out of 4 billion or so internet connected individuals. So, I do think that, it's going to be a pretty interesting gateway, and in a sense, when you look at gaming alone, that doesn't even account for the NFT effects of things like NFL Top Shots, which was just announced by Dapper Labs. So, obviously NBA was a success. NFL, why not? Right. So, so there are many avenues for mass culture and popularization, but, we do think gaming, is definitely an exciting one.
Absolutely. And, I think we plan to aggressively invest in the gaming ecosystem. I think we're starting to see three things we needed, which is one, the right teams coming into this space, teams that have founding producers at large AAA games that have led teams of creatives and art directors and developers to build out these games. We've got the second thing is infrastructure, right? We talked about this earlier. We've got side chains, we've got layer twos, we've got game specific side chains like Ronin on Axie or Immutable X. And so the infrastructure or scalable blockchains, we've got infrastructure that we can actually build these games. And then I think we've got the product market fit of play to earn finally being proved out by YGG, Axie, and some of these other games. So I think now is the time to be investing in gaming. And so again, if you're building a game, please contact us. We're interested in exploring investment opportunities there.
Absolutely. And just a heads up that we're gCC is an early stage fund, so we absolutely like first checks. We like to lead more than we like to follow. So we definitely are looking for these amazing builders out there. So I guess we're creeping up on the top of the hour. So I think we'll have to end it here. But just wanted to really thank you. I think it's been a really great show and really enjoyed this opportunity.
Yeah, I did as well. And maybe we can check in, do this again in the future and see how some of the predictions played out and reevaluate where we're going from there.
Absolutely. Great stuff. Thanks so much.
Awesome. Thank you.